So no doubt in terms of, since the financial crisis, the increase of activists and being aware of that is something that public companies have been having to deal with and think about how they communicate strategy and so forth. But I just want to, in the family-controlled businesses, so what is it specifically? What gives them the ability? Why better performance and taking? Is it because they take the long-term view and they get the performance? But what is it that we can learn from the family-controlled and maybe bring it across to the public world, widely held?
It's a flip answer, but I would say you don't invest in your children's education for the next quarterly outcomes. And there's a fair element of truth in that. Generationally, you would aspire to hand the company off to your offspring. That's happened in a number of Canadian family-controlled corporations. And you don't have these pesky little 26-year-old analysts phoning you up to say, what are you doing with my company? So you can focus your time on things that you deem to be long-term importance. The public companies coming out of Silicon Valley are almost all now dual-class shares. And Mark Andreessen and Ben Horowitz have a company that's $35 billion in market in their funding. And Mark Andreessen said at a recent seminar, he said, if I ever brought anything public, I'd bring it public with dual-class shares because I want to ensure that I'm working 120% of my time with the management team to try and figure out our way forward in the future. And I will not be distracted by other people. So I think it's a question of that longer-term family orientation, looking to the next generation. Maybe that's a little bit expanded as a time horizon, but you're certainly not going to be bothered by next quarter's earnings, and you certainly will invest for the medium and long term.
We were talking about this earlier, and one of the things, descriptions of family controlled was a little more agile, be able to respond to both risks and opportunities, and speed of decision making. I think, Paul, you had brought up that point too. Perhaps in the corporate setting, a much slower process to make change, whether it's a management change and whatnot. Your thoughts on that? The kind of the speed of decision making that needs to take place.
Certainly, it does take time, and there's a lot of consultative process and so on, and especially trying to understand what the shareholders are, what the perception of the company is. And one of the things that really affects management and boards is the amplification of media, and everybody's got something to say about it. So if you think of the 24-hour news cycle and MSNBC, and it just goes on and on and on, so your ability to kind of get away from the noise is very, very difficult. The importance of I think boards can respond quickly, but do they have the right information? Are they responding to the right stuff? That takes some time to understand.
The other interesting thing I looked at, and maybe David, you were providing some stats to me, but this was just around the CEO, the management leadership, and the tenure of the CEO in a family-controlled business versus what you typically see in a widely held public company. Some thoughts on that piece. I mean, if you have a CEO, the time frame is 5 years. You would expect some sort of direction. When I think about compensation, other things, that would be the kind of the time frame versus long term. But thoughts maybe of all the panelists on that piece. Andre, I don't know.
Well, it's a model that, quite frankly, is well known in the private equity world, where the time frame of an investment is 2 to 7 or 5 to 7 years to realize your investment and double or so your money. So I think that a lot can be driven, a lot of comparison can be driven between the two, of a widely held public company who's looking at the short term and a private equity model. And I think it's very successful, except that the private equity model doesn't have the same kind of pressure of on a quarterly basis giving the result that it has either forecasted or that the street is expecting.
I want to pick up this dual-class share structure. So, David, if I'm picking it up, I think about all the governance practices that are put out, and everyone's saying, to hit a good score, we got to do this. But lo and behold, we have a group with dual class, which probably wouldn't rate high on it, that is actually good. So is that sort of a new model for new times, that perhaps it's not the bad omen that everyone thought it was?
I think it's a deeper understanding based on facts now as to performance. And when we started the Coalition for Good Governance, we believed that the only kind of constituent of the ecosystem of well-governed companies were those that had one vote for one share. And we produced best practices, and that's still going on. And I think that has been very helpful in terms of producing better governed companies in Canada, in the United States, and elsewhere. But when you look at the numbers and say, dual class shares have significantly outperformed one vote, one share kind of companies, and then you say to yourself, what happened in the financial crisis? Who was governing the 15 banks that lost $2 trillion in shareholder value? And you discovered, there are 15 independent directors. All the banks had one share, one vote. And yes, it was the largest single write-off of shareholder value in the history of mankind. So, maybe this model isn't perfect. Maybe there should be considerations of other creatures in a larger ecosystem than we thought of before. And that's where I'm parked now. And at the Clarkson Center, we're trying to work with family corporations to understand what they do differently exactly, to understand their different approaches to governance and boards, and then to promulgate those best practices to the others in that part of the ecosystem. So I would say I've learned a lot since the bank crash.
Yeah, maybe sort of biased because I started my career in the 80s in Quebec, where family realized at that point, coupled with the fact that the government was giving incentive to go public, that if they wanted to have they needed to access capital, it was much easier for them to access capital through the public, but they didn't want to lose control of their company. And there's a number of success. So I think being rigid about, we are not going to invest in companies that have dual structure, I think you need to look at it on a case-by-case basis. And dual structure doesn't necessarily mean that it's better governance or better result, but I don't think that you should be so dogmatic as to say, I'm going to eliminate that of my portfolio.
Yeah, so it depends. It's interesting. I saw there was something from Don Lindsay, and of course Tech has the dual class. And the comment from the CEO was, given the current economic environment, having this structure in place actually has given us flexibility during the low commodity price, which we wouldn't have had otherwise. So there's some positive elements to that. Wes, I'm wondering, with activists, when they're looking at governance, and attacking governance practices, are they looking at, the so-called best practices, or what are they looking at in terms of, the governance matters?
Well, first of all, they actually stay away from dual class structures because, as David said, it's not one vote, one share. So they look at companies that are obviously widely held, lots of investors, lots of moms and pops. Yeah, there is a number of institutions as well. But in terms of the governance attack that they look for the companies that are just doing a lot of things wrong. And the perception out there is that activists generally target bad companies. They target good companies that are run by bad management, right? And so that's really what their job is. Their job is to find those companies that if you make a tweak here or there, that the stock is going to outperform and they're going to make 18, 20, 30% on their investment. But when you look at a family control business, there's a number of them in Canada we talk about, like the Atcos of the world, Saputo's and Couche-Tard and so on. There's some great companies. But those are not for the activists. Those are for people who are looking for consistent, decent returns.
David, I was interested in your comments about, it was, again, the McKinsey CPPIB survey and the long term. And I was still a little surprised. So you said most are operating in 2 years. They would say 3 to 5 is long term. Just reactions to that around, if we're talking about long term strategy, et cetera, is 3 to 5 really a long term strategy? Or what do we mean by long term?
Well, it depends on the industry you're in. Value Act has just taken a 10% position as an activist investor in Rolls-Royce in the UK. And there, the R&D expenditure is a huge percent of sales, and you could cut costs immediately by chopping out the R&D and triple earnings. But you'd destroy the company. So their idea of long-term in Rolls-Royce with engine technologies is probably 15 to 20 years. On the other hand, if you are in Hootsuite, your long-termism might be next week. You could be out of business. And you've had experience with long-termism in a different definition, Paul. So it depends on the particulars of the industry and the business, I think, Don.
And Andre, maybe, you know, as a long-term investor, when we say that, what is a long-term from your perspective? Is 3 to 5? Is that kind of what we're talking about, or?
Well, I think this concept of long-term investment for institutional shareholders has been used at various points, and my view is that it's fine to be have a long-term view, but you need to absolutely remain flexible in the type of investment and how you're going to manage your investment.